UPL's had a mixed quarter. While revenue grew by more than 80%, exceptional loss of about 305 odd crores hurt the bottom line. A large chunk of the hit came in from the US federal jury judgment that ruled in favor of Agrofresh Solutions. Joining us now to talk about the financials in greater detail is Anand Vora, the CFO at the company. Mr. Vora, thanks very much for taking out the time. So there are a few positives and there are a few negatives. So let's talk about both of them. One obviously being a 15% volume growth. Your working capital number of days has come off, so that's a positive. The negatives obviously have been on the gross margin front, which has come off by about 280 basis points. Could you tell us, in a nutshell, how has this quarter been for you on both the positives and the negatives?
Sure. Thanks, Devina, for having me on the show. I think it's been, as you rightly put it, a bit of a mixed quarter, although we are very positive because of the volume growth. And this has been, an important thing in a difficult market. We continue to gain market share and have grown significantly compared to most of our competitors or the peer group. On the what you're saying in terms of working capital, also we saw a reduction, so which is also positive. In tight money market situation and overall what we are seeing is a slowdown to bring down the working capital by about 4 days is certainly quite positive. So to that extent, I would say we are pretty much on track. In terms of gross margin, as I shared in my report also, we clearly, it's an issue of mix. 1, 2 is of currency, and 3 is mix in terms of geographical mix. We had Latin America having a significant share of our revenues in this quarter. Compared to that, we had reduction in US and in European markets, and therefore, as you know, these are more profitable market than that of Latin America, and therefore we had a slight dip in the contribution margin. And the second, which I told, was foreign exchange, and third being product mix. Few of our products we had seen a drop in the margins, largely coming out of pressure because of higher costs, and we were not able to push in higher selling price. But otherwise, we remain confident of delivering the numbers what we had set ourselves off in terms of the guidance of growth of about 16 to 20% growth in EBITDA over that of the previous year.
Okay, let's also talk about the capex guidance as well. You guided for, I think, about 2,000 odd crores. First half capex was, I think, closer to 850 crores. Is there a change there?
That's right. No, there's no change there. We continue to invest. A large part of the capex is towards product registrations, and we continue to do that as it helps us to grow at double digit.
All right. While obviously we are seeing a pickup in Latin America, margins out there seem to be slightly at the lower end of the spectrum. Do you see this as a trend that you're going to be seeing in the second half, which is also a seasonally stronger quarter for you, or the rest of the geographies will start to pitch in?
We expect the rest of the geographies to start pitching in, particularly Europe and US. But US has its own challenges. As you are aware, there are the trade war issues, hangover, which is still continuing. At the same time, US also had some very, very erratic weather, resulting in, particularly in the Midwest, there has been challenges in terms of sowing for the farmers. So we hope some of these would get sorted out. Typically, the farmers would be buying for the next season towards the Q3 and Q4 of ours. So we expect things to resume or normalize over the next 2 quarters.
Okay. Come in with regards to the overall competitive intensity that we're witnessing in North America. This time around, there was a negative 1% growth. There was a competitive pressure on Lifeline. There's some competitors bringing new molecules at low prices from China. So how big a threat is this for you?
Yeah, so as we mentioned, there have been challenging conditions. As I said, hopefully, as Q3, Q4 is typically the winter season in America, and as you would see that the buying which happens during this period is largely to be used in the subsequent, which is in the summer season, when March, April onwards, when the consumption begins. So at the moment, we have positive signals in terms of the following year. So we expect to be normal quarter 3, quarter 4 in this geography.
Let's talk about India as well, a growth of 6%. Is that likely to improve in the second half of the year? This time around, obviously, Ulala contributed, but is there a bigger contribution that you're expecting from any specific segment?
You see, the H2 in India, which is typically the Rabi season, is always a smaller season compared to the Kharif season, which is the monsoon season starting from June to probably September. And we start selling from April onwards as distributors start building up inventory. So the ratio is anywhere between 70-30 to 65-35, 65 or 70 in favor of Kharif, and 30-35 is towards the Rabi. However, as you know, it's been raining and we had a fairly erratic weather. We have rain still continuing in some parts of India. So there is a very high expectation of Rabi season being good this year. And therefore, we expect at least about, if not, we expect on the higher side, 35% of the sales to happen for the Rabi season this year. So that should augur well for the H2, which otherwise is always subdued. If you look at the previous years, it has been subdued. But this year, because of good water table, we expect a lot more land to come under Rabi, as farmers will go for second sowing because of the water table being good.
Okay, we spoke about net working capital coming off, and that was also driven by the fact that inventory reduction happened by 2 days. There was a 20-day reduction in receivables, 18-day reduction in payables. So working capital management for the second half seems to be in line, or you'll see an improvement of that as we move along?
Well, we'll work towards an improvement. When we compare with the last year, we are comparing with the pro forma numbers. And pro forma numbers includes those of Arista. Arista, as you know, had a higher working capital. But now as we move into to one operating as one company, and we move Arista business onto UPL SAP system, we would have a single invoicing, which means that there's a lot more Arista working capital trending towards UPL working capital number of days. And that would mean that there would be improvement in working capital compared to that of the previous year. So we would see an improvement if one has to see the blended working capital for the two entities in the previous year. Compared to that, we would see definitely an improvement in the blended working capital of now the new UPL or the combined entity.
Okay. Mr. Vora, two questions in one. I'm running out of time. One being the big concern that the street has with regards to the debt and how you're addressing that, and what's the strategy going forward out there. And the second and the final part is the guidance on various parameters. So 8 to 10% revenue growth, EBITDA growth guidance of 16 to 20%, integration cost of about $60 to $80 million, capex of 2,000 crores. All of that on track.
As of now, we are maintaining our guidance. We don't see any reason not to do that. So we haven't, changed our guidance. And as far as debt is concerned, we remain committed to bring down the debt. And one of the contributors of that certainly would be the working capital reduction, which I've already talked about. So we remain optimistic in terms of delivering our guidance, as well as also in terms of debt reduction. As of now, we remain quite confident of delivering those numbers.
All right. Mr. Vora, thanks very much for joining and really appreciate you taking on the time. That's the management of UPL sticking to their guidance on almost all of those parameters that they've spoken about earlier on. Thanks for watching.
So people, when they invest and the calls go